Ever felt like time is slipping away and your money's burning, while others multiply their wealth effortlessly? What if you can start managing your money and building wealth in just 15 minutes a week? Today, we'll dive into the book Rule Number 1 by Phil Town and discover the power of value investing. In the book, Phil Town teaches investors to focus on understanding a few valuable businesses deeply, buying them when undervalued, and selling when overpriced, all while spending just 15 minutes a week managing their portfolio. In the next few minutes, we'll unravel the core principles that could be your ticket to financial independence and success. Let's dive in. Here's the super quick book gist in 100 words or less. Rule Number 1 by Phil Town teaches you the essentials of value investing. The core principle is to never lose money. The book guides you through the 4 M's of investing, meaning understanding the company you invest in. Moat, identifying its competitive advantage. Management, ensuring it has competent leadership. And margin of safety, buying at a discount to its intrinsic value. Town offers tools to help us assess a company's value and highlights the importance of the PEG ratio. He also introduces us to basic technical analysis and underscores the significance of making emotion-free decisions. With this approach, we can effectively manage our investments in just 15 minutes a week and build our wealth. Takeaway number 1. The myths of investing. Almost everybody is persuaded that a higher rate of return essentially implies more risk, and they're more scared of losing money trying to get a higher return than of their inability to retire easily. In the book, Town argues that the truth is a higher rate of return is not necessarily dependent on incurring significantly more risk. If you don't know what you're doing, your journey will be either very slow or very dangerous. The key principle of Rule Number 1 is knowing what you're doing, investing with certainty, so you don't lose money. Let's delve into some common myths. Myth 1. You have to be an expert to manage money and invest. Rule Number 1. Contrary to that belief, the right strategy, like Rule Number 1, simplifies investing to 15 minutes a week. Myth 2. You can't beat the market. Rule Number 1. By being vigilant, one can leverage market mispricing and potentially enjoy returns of 15% or more. Myth 3. The best way to reduce risk is diversifying and holding for long term. Rule Number 1. The true key is identifying undervalued assets, buy $1 for 50 cents, and sell it later for $1. Repeat this step until very rich. Phil Town's Rule Number 1 advocates for a thorough comprehension of your investments, which negates the conventional wisdom of diversification. Instead of spreading money thin across a myriad of investments, the emphasis is on in-depth research to pinpoint a select few businesses that are truly valuable. The strategy is to buy these businesses when they're undervalued or priced low, and sell when their stock prices reflect their true worth or are high. By concentrating on a few excellent opportunities and understanding them deeply, investors can maximize returns and manage risk, thereby sidestepping the need for broad diversification. Takeaway number 2. Rule Number 1 and the 4 M's of business. So, what is Rule Number 1? In the book, Rule Number 1 literally means don't lose money. But in practical terms, it means to invest with certainty by buying a wonderful and valuable business at an attractive low price. The title's Rule Number 1 is a reference to Warren Buffett's 2 rules of investing. 1. Never lose money. 2. Never forget Rule Number 1. In practical term, Rule Number 1 involves 4 essential steps. Step 1 is to find a wonderful business. Step 2 is to know what it's worth as a business. Step 3 is to buy it at 50% off as an attractive low price. Step 4 is to repeat the previous 3 steps until very rich. The form is. When thinking about the process of finding wonderful businesses at attractive prices, Town introduces 4 key principles, known as the 4 M's, to help individual investors identify wonderful companies to invest in. The 4 M's means meaning, moat, management, and margin of safety. 1. Meaning. The first question is, does the business have meaning to you? This implies 2 other questions. 1. Do you want to own the whole business? 2. Do you understand it well enough to own all of it? Invest in companies you understand and are passionate about. The foundation of investing is to put your money into businesses you genuinely comprehend and feel a connection with. By understanding the business, you can better anticipate its future and avoid being swayed by short-term market fluctuations or misinformation. If you don't understand the business, how can you understand its future? Invest in what you know and are passionate about. Also, buy every business with the 10-to-10 rule in mind. The 10-to-10 rule says, I won't own this business for 10 minutes unless I'm willing to own it for 10 years. This rule helps us remember how long we're willing to own this business, so we're always thinking of this investment as long-term. As a rule number 1 investor, you're going to own only a few businesses. So you have to be sure you own the right few businesses that won't lose your money. 2. Moat. Invest in companies with a durable competitive advantage that allows them to fend off competitors and remain profitable over the long term. As a rule number 1 investor, the first thing you want to know when you're about to buy a business is whether or not its future is predictable. You should never buy a company whose future is uncertain. A moat refers to a company's defendable competitive advantage, a unique trait that sets it apart from competitors and ensures its sustainability. Here are the 5 moats you should look into. 1. Brand. A product you're willing to pay more for because you trust it, for examples, Nike, Coke, Disney. 2. Secret. A business with a patent or trade secret that makes direct competition illegal or very difficult. For example, Apple, Intel. 3. Toll. A business with exclusive control of a market, giving it the ability to collect a toll from anyone needing that service or product. Examples include media companies, utilities, and agencies. 4. Switching. A business that is so much a part of your life that switching isn't worth the trouble. For example, Microsoft, ADR paychecks. 5. Price. A business that can price products so low no one can compete. For example, Walmart, Costco, Home Depot. You can consider and decide if a company is a good investment by looking if they have multiple moats around it. The more likely it's a combination of several moat categories, the more likely it will be a good investment that won't lose your money. The big 5 numbers of a moat. If a business has at least one of the 5 moats we mentioned earlier, it will show up on the big 5 numbers below. 1. Return on investment capital, ROIC. It's the rate of return a business makes on the cash it invests in itself every year. If a business has no healthy ROIC, above 10% per year on average for the last 10 years, then it's not a good choice and you should move on to find another one. 2. Sales growth rate. Sales are the total amount of money the business took in from selling whatever product or services. The business will report its sales each year, allowing us to see if sales grew compared to last year. A good way is to see 10 years of numbers. It will give us an idea if sales are growing consistently. 3. Earning per share, EPS, growth rate. It shows us how much the business is profiting per share of ownership. Number 4. Equity or book value per share, BVPS, growth rate. Rate of equity growth tells us the business can accumulate a surplus, and that in itself makes it exceptional. Equity is more or less the take-home money if a business is not sold as an ongoing business, but instead the machines, supplies, and real estate are sold off. The proceeds of the sales are added to whatever cash the business has in the bank, the debts are paid off, and the remaining cash is divided up among its owners. Equity growth is a good indicator of a company's strength. If a business's equity isn't growing, the business doesn't have the funds or potential to increase its market or develop new products. 5. Free cash flow, FCF, growth rate. Cash flow represents the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. Unlike earnings or net income, free cash flow is a measure of profitability that excludes the non-cash expenses of the income statement and includes spending on equipment and assets. Cash flow tells us whether its cash is growing with its profits or if the profits are only on paper. All of the big 5 should be equal or greater than 10% per year for the last 10 years. The big 5 numbers are often calculated on some professional sites, which cost money. But there are also some free sites like MSN Money or Yahoo you can take a look at. If the business you want to invest in has one of the 5 moats and the big 5 numbers look better than 10%, then go to the next step. If not, drop it from your list. 3. Does the business have great leadership and management? The third M means good management. A wonderful business should have a leader who will drive the business to achieve a big audacious goal. This stresses the significance of who's running the company and how they're doing it. In rule number 1, Philtown references the concept of the level 5 leader, which is originally from Jim Collins' book Good to Great. The level 5 leader's essential qualities can be summarized into 2: owner-oriented and driven. An owner-oriented CEO is one who has his personal interests directly aligned with the shareholders of the business. An owner-oriented CEO will seem to be acting as if the company were the only asset their family will own for the next 100 years. This makes him an ideal figure at the helm of a company from a value investor's perspective. 4. Demand a margin of safety. The fourth M means the margin of safety, and it's the practical part of this book. Your goal in this step is to buy $1 of value for 50 cents. We first determine the correct sticker price on a chosen business. Then we determine the margin of safety. This is what we call attractive price. Margin of safety is half of the sticker price. It's important to get a margin of safety on every business you buy, no matter what kind of business you're buying. Why pay full price when you can buy value on discount? Always ensure a cushion between what you pay and what it's worth. Sticker price has several other names in the financial world, including fair value, retail price, etc. The sticker price of a business is more than the value of its parts. The major part of a business's value is the money it's going to make in the future for its owners. The sticker price is the value at which you should be willing to buy a company's stock, while the margin of safety indicates the desired purchase price, ideally at half the sticker price. To get the sticker price, you will need to know the following 4 numbers. 1. Current EPS. Earning per share. 2. Estimated future growth rate, EPS. 3. Estimated future PE, price/earnings. 4. Minimum acceptable rate of return from this investment. This is the annual return rate you'd like to achieve on this investment. Philtown often suggests using a rate of 15% as a standard, but this can vary based on individual preferences and risk tolerance. These numbers can be found on the company's income statement and annual reports, through analysts' estimates on financial websites, by evaluating historical and industry data, and by determining your personal desired rate of return. The amount of money a business makes is called earnings or profits, and the most accurate way earnings are reported to owners is called earnings per share, or EPS. So, what we really want to know to get started is what the EPS is going to be in future. To get the sticker price, follow these steps below. 1. Grow the currency EPS at the estimated EPS growth rate for 10 years to obtain the future EPS. 2. Multiply the future EPS by the future P equals price/EPS, to obtain the future market price. 3. Shrink the future market price by the minimum acceptable rate of return per year to obtain the sticker price. Finally, the margin of safety is half of whatever the sticker price is. Takeaway number 3. Know the right time to sell. Warren Buffett said, "The right time to sell a company is never." So the perfect business to buy is the one we never have to sell it. We're holding it a lifetime, so it continues to make us rich. However, there are 2 times to sell your stocks. 1. When the business has stopped being wonderful. 2. When the market price is more than the sticker price. If the company you've invested in starts showing signs of deterioration, or if there are shifts in its fundamentals, like eroding competitive advantage, declining market share, or managerial issues, it might no longer qualify as a wonderful business. On the other side, if the current market price of the stock purposes its calculated sticker price, it might be an indicator that the stock is overvalued. In such a scenario, selling could be a prudent decision to capture the gains before any potential market correction. It's worth noting that the stock market can be volatile, and stock prices fluctuate regularly based on various factors, many of which might be short-term or unrelated to the company's actual performance. If you buy a business, and the price starts going down after you bought it, you can deal with this by telling yourself that even though the stock has gone down in price, you haven't really lost any money as long as you hold and don't sell it. In other words, just pretend you're not losing money and therefore not violating the rule number 1. Not losing money. Above all, your goal is to buy $1 for 50 cents. After you've found at least one business that has meaning to you, the one that you would be proud to own and understand. Do all your research homework to see if the business meet the 3 of the 4 Ms. Meaning, moat, and management, and then calculated your margin of safety, so you know when to buy in at an attractive price. Take your time and don't let fear of losing money to hold you back. And the most important one to remember, never violate rule number 1. Thank you for watching this video.